I know I've seen them before. Meetings, so I know.
You're live.
Wonderful. Welcome, everybody. It is December 16th, and it is the final meeting of the Joint Committee on Pensions. I'm Senator Sarah Elfreth. I chair the Senate Committee side of the committee, joined by Delegate Brooke Lehrman, who is the House Chair of the Joint Committee. And as tradition, our final meeting of December is our decisions meeting. And we're also going to receive the investment overview from the system. And because we have a couple of members who are juggling multiple joint committees today, we're going to start with the decisions and then go on to the investment. So we're flipping, we're sticking with the decision, the outline that I think was the published agenda. And with that, I will turn it over to my co-chair, Delegate Brooke Lehrman.
Thank you, Chair Elfreth. It's great to have everybody joining us today. And in case she cannot stay the entire meeting, we wanted to start off this meeting by noting that this is Treasurer Kopp's final joint pension meeting. It has been, I think, an honor for all of us to have you join our meetings, to keep us up to date on what's going on in the pension world. We appreciate all of your incredible. We appreciate all of your work. Okay. Treasurer Kopp has been serving on the pension board since 2002 when she became treasurer, and she's been chairing since 2007. So I think it's safe to say that there is no one who understands what's going on at our pension system more in the state of Maryland than Nancy Kopp. And I think we all will miss you. We are excited to welcome our treasurer-elect Derek Davis, but it doesn't take away from the amazing work that you have done. And you've been a friend to all of us, a leader for all of us, a great mentor to many of us. And I'm just really grateful for the work that you've done. Thank you, Treasurer Kopp. And I think with that, we are going to get started. We are going to turn it over to June Chung and Philip Anthony, analysts with the Department of Legislative Services. And then also we will hear from Ann Gothrop, the Director of Legislative Affairs for SRPS. June and Philip, take it away.
Okay, thank you, Madam Chair. So we have a hefty list of bills to get through, so I'm going to launch right in. The first bill relates to trustee election clarification. So this bill clarifies that only active members may serve in certain trustee positions on the board membership, and also codifies existing practice to limit ballots in trustee elections to active members. Current law requires that the Board of Trustees is composed of certain members elected by members of the systems, but does not explicitly require them to be active members. After research, a review of legislative history, and an analysis of agency practices in trustee elections, the agency believes that the legislative intent was to extend voting in trustee elections to active members and to require members who serve as trustees to be active members.
Is there any discussion? Should we move while we go through, Chair Elfreth?
I think
Okay.
that's best, yes. All right, I'm not seeing any hands for questions or discussion.
Is there a motion?
Move to sponsor the legislation.
Second.
Moved and seconded. Good.
How about you do this and we'll go back and forth.
Okay, we'll go back and forth. It's hard when you can't sit next to each other and communicate this, passing notes, right? All those in favor of sponsoring the requested legislation, please say aye.
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 Any opposed? Okay, motion carries.
Okay, the second bill. The second bill relates to purchase of service in the judge's retirement system. This bill repeals provisions of law that permit a member of the judge's retirement system to purchase prior service credit under two specified circumstances. Under these provisions and the mandatory requirement that a judge retire at age 70, a member of the judge's retirement system would be eligible to purchase service only if the member had been younger than 24 when appointed as a magistrate in chancery or juvenile causes, or younger than 26 when appointed to the Workers' Compensation Commission. Given that the agency also has not received an application from a member who would be eligible to purchase this service in the last 20 years, these provisions are obsolete. So this bill would basically just repeal these provisions.
Thank you, June. Any questions or discussion on this proposal?
Move favorable.
Thank you, Senator Eckers. Thank you,
Second.
Senator.
Second.
All those in favor, say aye.
Aye.
Any opposed? Okay, motion carries.
Okay, the third bill basically corrects a drafting error. The third bill repeals an inconsistent reference to the state police retiree death benefit for surviving spouse and minor children as 50% in provisions of the DROP program for state police. So basically legislation in 2008 increased that death benefit from 50 to 80%. So there's still a remaining provision that refers to it as 50%. So this one's easy. It just repeals that incorrect reference.
Move favorable.
Great. Is there a second?
Yeah. Second.
All those in favor, please signify by saying aye.
Aye.
Any
Aye.
opposed? The
Hello.
motion carries.
Okay, so the next bill deals with investment division compensation. The bill consists of two parts that address compensation levels and forfeiture of incentive compensation. So to provide some context, legislation in 2018 authorized the board to create positions and set compensation necessary to carry out the professional investment functions of the investment division, in part to address issues of retention and also to set competitive salaries for the chief investment officer and the investment division's staff. So more specifically, what this legislation did is it limited an increase in compensation to no more than 10% annually for certain investment division positions. The unintended effect of that bill has created significant disparities between staff hired before the 2018 bill and after the bill. So the first part of this bill authorizes the board to provide investment division staff who were hired prior to the 2018 legislation to receive a compensation increase that is more than 10%, but not more than in 2 one-time salary increases. So the second part actually deals with forfeiting incentive compensation. So again, under this legislation, the board is prohibited from paying out any unpaid financial incentives after the CIO or investment division staff separate from the division. So this bill also structured the incentive compensation to be paid out over a 2-year period. So the second part of the bill provides an exception to the prohibition on the board for investment staff who retire directly from the division. So under this exception, a staff in the investment division who retires directly from that division will be able to receive any outstanding incentive compensation within a 30-day window after the person retires. So I think the reason why we created that 2-year payout was to create incentives for retention. So we didn't want to penalize people or prohibit them from wanting to retire early. So we just wanted to, so what this bill does is just, it ensures that an investment staff person who retires will be entitled to receiving all of the compensation they've earned.
Thank you, June. This is a slightly more complex issue, but any discussion or questions, it's laid out pretty well in the decision document. Okay, is there a motion?
Move to sponsor the legislation.
Thank you, Delegate. Is there a second?
Second.
All those in favor, signify by saying aye.
Aye.
Any opposed? Okay,
Okay, so the next bill updates the approval process for real estate transactions by removing the requirement that a majority of the ex officio trustees approve all real estate transactions for the system. So this approval was established by legislation in 2007, but it's not common practice to have individuals or groups outside of the governing body of a pension system to have authority over real estate transactions. And the general industry standard is to permit the governing board of a pension system to have authority over all assets in a system. So what this bill does is just update the process for approving real estate transactions and allows that to be under the governance of the board.
I do have a question about this.
Sure, go for it.
So are we talking about just commercial property, or is there like residential, any residential or like condominium buildings or whatever involved in this? Just asking.
I'm going to defer to Ann Gothrop. I think she would probably be able to answer that question better than I.
This bill, Delegate Krim, as we're proposing, would address only direct real estate transactions.
Only address what?
Direct real estate transactions, so investing directly into the real estate properties ourselves directly, as opposed to investing as we are currently in real estate funds.
Oh, okay. So does it include residential property or commercial, or would it include that? That's my question.
Okay, Andy, would this include, I assume that we would be investing in residential properties or commercial real estate properties. Andy, correct me if I'm wrong.
Yes, and we would invest in office buildings, retail buildings, a lot of multifamily, which would be rental buildings. And the industry has actually started investing in individual homes as retail, as rental properties as well. That is a strategy that we've seen some of our managers do. I don't know if that's something we would do directly, but but definitely would include places where people live.
Okay, so this concerns me a little bit, Madam Chair, because I've read recently about a lot of people who are being priced out of their homes, and that's because larger investment groups are purchasing these real estate properties. I'm just concerned about what are we getting into? Are we getting into something like that where we would be the controlling authority that wouldn't allow people to stay in their homes? I'm just asking.
Yeah, so my understanding is that the pension fund already invests in real estate holdings. And this bill would remove the requirement that some of the trustees have to approve each real estate transaction. So I do think, and this came up last time when we were starting to discuss this, I do think that the committee, like Delegate Krim has indicated, is concerned and interested in this idea of investing in real estate and investing in portfolios that invest in real estate. So it is, and I hear your concern, Delegate Krim. So I am happy to defer to the committee if Ann or if you and Andy want to try to clarify further to provide some additional clarification on on how narrow this is, or provide additional clarification on real estate holdings more generally now or in the future.
Madam Chair, Andy and I and the others at the agency have been talking about this since our last meeting, and we heard the concerns you raised before, and Andy was, I think, prepared to discuss them during his response in the investment overview. Some of the concerns you raised, that you would prefer, we can put the response in writing. It's up to you.
Well, why don't we hold on this decision then until after our investment overview conversation, and then we can, is that okay with you, Chair Elfreth? And then we can.
My only concern is I think we might be losing 2 Senate members because of the other joint committee.
Right.
Yeah.
Yeah. Well, we could hold it. I mean, if people are concerned about this, if there are concerns about this bill, then, we can certainly hold it and decide at a later date too.
I recommend to hold it.
Okay. Chair Elfreth, do you have, or other senators?
I think maybe we should, just for the sake of everybody feeling comfortable, hold it for now.
Okay, that's fine. Okay, let's move on to the next one.
Okay, so the next is special legislation. For those of you who have been members on the committee, I think you're familiar with these very specific types of legislation that come up to address certain situations. So this bill would direct the agency to accept a retirement application that was received on May 5th, 2021. If you recall, Anne presented the story, and I'll just give you a quick summary of it, that the applicant died before being able to correct the flawed notarization of her retirement application. She was applying for a benefit that would return the present value of the retiree's retirement benefit that remains at the time of the retiree's death. So basically what happened was the agency received the application, it was flawed. They notified the applicant, and then the applicant's family member informed the agency that the person had passed away on the day that they had actually sent in the application. So due to just a flawed issue with the application, this bill is addressing that situation and is requiring the agency to just accept that retirement application as full and as proper.
Right.
Move to sponsor the legislation.
Thank you. Is there a second?
Second.
All those in favor?
Aye.
Aye.
Motion carries. Thank you.
Thanks.
Okay, so the final bill I'll be discussing is that this bill addresses an inconsistency in current law on an exemption from an earnings limit reduction for retiree who is reemployed as a parole and probation officer. So basically, if a retiree is reemployed as a parole and probation officer, they're exempt from the earnings limit reduction. What happened was in 2012, this exemption was established, but at that time, the parole and probation officers were in the employment system. In 2017, those parole and probation officers were moved into the correctional officer system. So basically, the 2017 bill did not have a similar provision that extends that exemption for reemployment. So what this bill would do was would add a similar provision to the core statutes.
Okay. Are there any questions? Is there a motion?
Move to sponsor the legislation.
Thank you. Do we have a second?
Second the motion.
Excellent. Thank you. All those in favor of sponsoring the requested legislation, please say aye.
Aye.
Any opposed? Okay, the ayes have it. Thank you. I'm gonna turn it
All
over
right,
to
these next few I'll be presenting. The first one for your consideration is related to the COVID death benefit bill from last session. That bill has had a sunset provision of this coming June 30, 2022. You received some information from the agency about the utilization of this. Under this bill from last year, there's been so far 44 claims that have been made. And so a policy option to consider would be whether to extend the sunset of the bill out to a future date. I know last year when the bill was initially discussed, there was some contemplation that this may be needed.
Yep.
Okay, we are extending it by 1 year. Okay.
Yep.
Yeah.
Any discussion or questions?
No, but I'll just say that I think this is recommended. I mean, we're still in the midst of the pandemic and new variants keep coming along. So I will move to sponsor the legislation.
Second.
All those in favor?
Aye.
Aye.
Delegate Member Partners.
All good.
The next item I have for you is back at the November meeting when you were hearing presentations by the unions, the Maryland State Education Association raised a concern about staffing issues being experienced in the school systems. And there was some discussion about the school system's interest in bringing back retired teachers. And there is a current, across most of the systems, a provision that when a retiree comes back to work in a reemployed capacity, they may be subject to an offset, and whether or not this was factoring in as an impediment to the school system's abilities to bring back retired teachers in part-time capacities. And so what the policy option here I have for you today would be under the reemployment provisions, there are a number of exemptions. And there is a category which is kind of a broad, all-encompassing, think of it as like a wild card for each school system to bring back up to 5 people. One option to avoid the impediment that the reemployment offset may be causing would be to do an increase to those exemptions for school systems. Usually when a new reemployment exemption is implemented, there's a sunset and reporting period also. So that's another consideration for you all to make.
Great, thank you. It sounded like a very sensible idea to try to push back against the real crisis that we're facing in teachers, with teachers. So any thoughts or discussions or questions about this? Any motions?
I move to approve the legislation. Yeah.
Great, great. Okay. All those in favor of sponsoring the legislation, please signify by saying aye.
Aye.
Any opposed? Great, motion carries.
The last item I have for discussion is regarding the system investment climate risk. You had some presentations back at the October meetings regarding how the system manages climate risk. There was a legislation a few years ago that requires a more broader risk assessment of the system, including climate risk and reporting. And you received some other presentations on what's being done across various various institutional investors and heard from the retirement system. You also received an update from the systems AG kind of outlining the fiduciary considerations that factor into how the system is required to manage the trust money in the system. And so the policy options we have for you is whether the committee is interested in sponsoring legislation to kind of more thoroughly address the manner in which the investment portfolio incorporates the consideration of climate risk when managing the system investments. And we have a number of kind of policy considerations for you. One would be to look at this through the lens of consideration of climate risk as a fiduciary responsibility of the system in terms of the risk to the system's investments and also the opportunity for the system to invest when factoring in climate risk, requiring review of the portfolio to assess where those climate risks are in the current assets, identification of high impact sectors, identification of investment opportunities in emerging technologies, and also transitional opportunities. Making those assessments regular, so it's not just a one-time thing, it's an ongoing fiduciary obligation. And then additional considerations for basically gathering best information related to climate risk and using that to take action, whether it be investing or divesting from certain investments that the system has within that context of those fiduciary responsibilities.
Great. Thank you for that synopsis. Senator Elfreth.
Yeah, I just want to thank Philip and June for working so closely with the system and with us on crafting what I think is a very responsible policy moving forward. And certainly this conversation, this concept would not have even been started if it were not for Treasurer Kopp's leadership on this very issue. I know it's something that's important to her as well. And frankly, we've had many conversations in this joint committee about Maryland's, frankly, outsized vulnerability to climate change. And I can tell you as a representative of a waterfront district, we are high on the vulnerability list, maybe outside of Florida. So taking a more concerted stance here, codifying that climate risk should be a fiduciary responsibility of the system is frankly, I think, a very responsible and measured approach to this challenge.
Yeah, I agree. And I wanted to thank June and Philip for working on this, as well as some other members. I also appreciated that, actually some of the unions, I can't remember which union brought it up, that this was something that their members were also concerned about and interested in. So thank you. I see some questions. Delegate Mangione.
Thank you, Madam Chairwoman. My question, I guess, is there an example that maybe the council can identify? I'm just confused with how this applies. If anybody can offer an example, so I know kind of a better gauge of whether or not to support the policy. Thank you.
Sure.
It's a great question. Phil-
I'm sorry, go ahead.
No, I was gonna say, if you wouldn't mind.
Yeah, this would be, this approach may be a little different than what some other systems have done. I know New York, and there are some other systems that have established policies factoring in the considerations of how the climate risk will affect their portfolio, both in their current assets and moving forward. My general understanding is that from an institutional investor perspective, this is, if not fully accepted, definitely on its way to becoming a best practice consideration. And so the approach that may be a little unique here is that this concept is also factoring in those fiduciary obligations, which you were presented on by the system. And so the system has to act in the best interest of the plan participants for providing benefits. And so this would be an approach that should be consistent with that, while also providing for mitigating that risk to ensure a long-term sustainable portfolio, both on avoiding losses, but also seeking out investment opportunities.
Thank you for that.
Thank you.
Delegate Krim.
Thank you, Madam Chair. So this one bullet point, utilization of divestment when assets are not in conformity with system climate risk objectives. Does that mean like investing in carbon energy, like coal companies, oil companies? I mean, what does that mean?
It means that if, and certainly Philip or Andy or others are welcome to discuss this too, but in keeping with our fiduciary risk, if the system identifies that there's an industry that we are investing in, and after trying to engage with that industry to ensure that they are reducing their climate risk, and therefore increasing their potential earnings over the long term, so that our stocks and holdings would be doing better over the long term. If that company isn't doing that, then we should not be holding that company's stocks anymore, because they will, because we have, the pension is patient capital, right? And those stocks in that company will do worse over the long term. And so we should leave and sell and go someplace else.
Delegate Grimm, I'll also add that we did a pretty thorough, Philip and June certainly took the lead on a very thorough look at the other movements from other systems, New York being the lead. And Philip, correct me if I'm wrong, but New York explicitly laid out certain companies, which that was the New York bill. And a couple of other systems have done that. We did not feel like that was an appropriate stance here, but we wanted to certainly codify some of the best practices that the system is already utilizing, lay out a process by which they can make the most educated decisions based on our unique vulnerability as a state. But of course, with the fiduciary obligation kind of overarching and weaved throughout this policy. The other piece I find really exciting for our Maryland economy is to look towards the future of new and emerging technologies that I think will be some pretty exciting investments moving forward. So again, I think this is a very balanced approach based on a thorough evaluation of what's going on across the country. Senator Eckert, I see your hand.
Oh, thank you. Thank you very much, Madam Chairs. I'm just wondering here, does this elevate climate risk above all the other risk factors in assessing our fiduciary responsibility and looking at our investment portfolio?
I do not believe so, but I'll defer to Philip and others. No,
Andy?
No.
The concept here is that for all this to be run through the existing fiduciary obligations. So but it's also making clear that these are considerations that need to be factored in. So to the extent they carry weight for making an investment decision choice, we'll be, having that information, and the system will be able to act on that.
And how many of these do we already do this? is my next question.
We do a lot, the system already does a lot of this. And so, I mean, the piece about the fiduciary duty, I would posit that, you know, a lot of what the system already is doing is consistent with that. I think we are on, you know, managing the fund, at least considering those factors so far. This would be a more clear direction on how to carry out those functions moving forward.
Mhm. And this honors what they call the prudent man rule.
Yeah, arguably not considering these things would be in violation of the prudent person rule.
Prudent person rule. Got it.
Is there a motion?
Thank you.
They're excellent questions.
Yeah, great questions. Do you have any motions on the options? Move. Delegate Elfreth, you want to move?
I'm happy to move that we take this up as a joint committee priority.
Second.
Second.
Oh, we got a few seconds there. Okay. There's a motion on the table. Delegate Mangione, did you have your hand raised or did I miss that?
Sorry, man, that was an accident.
Okay, sorry. Any other, all those in favor of sponsoring legislation to codify the system fiduciary duties, please say aye.
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 Any opposed? You can raise your hand or say. Okay, we have one opposed, Delegate Mangione. Any others? I don't see any others. Okay, the motion carries.
Okay, we're at the end of our document. I do want to take a moment and recognize Chair Gazzoni has joined us, and I want to give him the opportunity to.
Thank you, Chair Alfred. It would be remiss of me not to take a moment here. I know other people have said things about Treasurer Kopp, and I just after many, many years of watching her and then working with her skillfully manage the state's finances, it's just, you know, when you see both a decency and a thoroughness of understanding of issues and work ethic, I mean, it's just Treasurer Kopp, you just you've been amazing. We're grateful as individuals who work with you, but grateful as people who represent the state, knowing what you have done and the legacy you've set. You know, the wise counsel that you have given us over many, many years, I hope has ingrained itself into many of us as we move forward, and you will sorely be missed. Thank you.
Thank you, Chair. And I'll just add, Treasurer Kopp, you were talking about climate before it was cool, and the rest of the system. So
much warmer now.
Yeah. And I just like to welcome Treasurer-elect Derek Davis. This is certainly the first meeting I've been on where we have two treasurers. So it's very exciting to see you. Thanks so much for joining us, Treasurer-elect Davis. It's great to have you. We've just finished our decisions on the legislation that we'll be bringing this year. And we are going to move on to our investment overview next. So Treasurer Kopp, are you going to start us off per usual, or?
I will just
Okay.
start off by thanking everybody for their support, their friendship, and their kind words. Let me put in a plug that I think that the legislation that will come out of this committee regarding climate change impact will be, in fact, more responsible than the most of the others, which do not put it in a context of fiduciary responsibility and risk management. And for that, I thank you very much. And trust the committee will continue inquiring as to how we are doing from time to time too. And one more plug, since you said I had been with the pension issue in the committee for 20 years. I would only point out the 27 years before that, including under the tutelage of the first delegate proctor, our chairman. With that, I'd like to turn it over to Andy or Ann, however it's going to be done, for a report on a very good year. I came into the board 2002. It was not such a great year, you may recall. This is a much happier time. Thank you. Wait, one more thing. I mentioned the treasurer-elect was trying very hard to make the meeting despite some earlier incidents, and I just want to welcome him, congratulate him, and pass it on.
Great. Thanks for passing on the baton. I think Philip is going to kick us off. So Philip, we'll turn back to you.
Thank you, Madam Chair. I'll wait for, I think June's pulling up the document. While we're getting up the document, I did want to thank, recognize the assistance of the members of the system, CIO Andy Palmer, Deputy CIO Bob Bird, Director of Legislation Ann Gothrop, and Martin Noven, the new Executive Director, for their assistance in helping me pull together all this information for you today. I'm going to try and move along pretty quickly, but if anyone has any questions, feel free to interrupt me. We're going to start by skipping ahead to Exhibit 2 on page 5. And as shown here, we see the system's investment return for fiscal 2021 was 26.69%. That is net of management fees, and exceeding the assumed rate of return of 7.4%. The system also exceeded its policy benchmarks for the system as a whole and a number of asset classes. As seen in Exhibit 2, the total system assets reached $67.9 billion as of June 30, 2021, an increase over the $54.8 billion in assets at the close of fiscal 2020. We had significant investment gains. I would note significant investment gains or losses can impact the allocation of the investment portfolio to certain asset classes. And so as we experienced that this year, the investment returns in each asset class can result in deviations from the target allocations, requiring additional oversight to maintain the overall asset allocation within the system's established risk tolerances. And so the first request we've had for comment from the system is to comment on the actions taken to maintain those target asset allocations and how the system managed the allocation during fiscal 2021 while experiencing that significant investment growth. On page 6, Exhibit 3 shows the system returns compared to benchmarks. The system returned excess of 2.27% above the benchmark for the whole plan, further enhancing the system's record returns for the fiscal year. With the exception of the rate-sensitive asset class, all of the major asset classes, including their sub-asset classes, achieved returns in excess of the assumed rate of return of 7.4%. The rate-sensitive asset class did have a negative return on the whole for the year, though it did outperform its benchmark. So there were some savings despite that negative return by avoiding some losses. Public equity had the most significant performance, beating the benchmark by a little bit over 4%. On page 7, we have our next comment. This is a perennial comment request. We've asked the system to comment on their 2021 return performance in relation to the policy benchmarks, and for any assets and sub-asset classes that underperformed their benchmarks, the factors that led to that underperformance, and whether those factors are expected to negatively affect performance in fiscal 2022, and if so, what actions are being taken to mitigate those factors. The next section of the report deals with performance relative to other systems. So this is the TUX information. One method of evaluating the system performance is to compare the system with the performance of other systems. The TUX rankings for 2021 had ranked the system's total fund performance in the 64th percentile among public pension funds with at least 25 billion in assets, as seen in Exhibit 4. As the system has historically had a lower allocation to equity investments compared to its peers, and then also within that equity investment, we don't have a bias to US domestic equity. The system's investment policy overall TUX ranking can be affected by the performance in those markets when other systems with higher allocations experience strong returns. So because the impact of asset allocation can drive the relative performance comparisons, one additional way of evaluating the system would be to look at the TUX rankings by asset class. So it's a little more apples to apples comparison. And as shown in Exhibit 5, when we break it down by each type of asset, you see that the system performance is significantly better than the 64th percentile for the total fund. And in particular, you have assets like private equity with ranking in that top first percentile over the 10-year period. I would also note that allocations that limit exposure to more volatile asset classes should result in more stable employer contribution rates over time. That has kind of been the philosophy of the board since the Great Recession. That lessening of the volatility will also result in less volatility to the employer contribution rates. Systems asset allocations are going to be impacted by a number of considerations that are unique to each system and that system's risk tolerance, such as the system's maturity, which is the ratio of retirees to active members, system's funded status, its assumed rate of return, its benefit structure, the regularity of full contributions, which Maryland has been very disciplined in, and other considerations can factor into a system's risk tolerance. So I would just point for a note that, when you're looking at system to system, you have to remember that there are multitudes of factors that can factor into how they're investing. Our next request for comment at the bottom of page 8 is just ask the system to comment on the relative TUX performance rankings by asset class, and then a little more information on how the asset allocation impacts those TUX rankings for the overall performance. Moving on to page 9, discussion of investment management fees on Exhibit 6. Systems investment fees grew substantially to 544 million for management fees in fiscal 2021 compared to 364 million in fiscal 2020. This increase is going to be largely attributable to the 13.6 billion in growth of the system assets. So with more system assets under management, you have higher fee structures. Additionally, we had significant increases in incentive-based fee arrangements, which are going to be reflective of those substantial returns that we saw over the past fiscal year. I would note that reviews of the system's fees by their investment consultants have previously noted the system appears to be more effective at negotiating favorable fee arrangements than peer systems. Also, transitioning assets to internal management is expected to result in fee savings to the system as that internal management function is built out further into the system. Moving on to page 10, I have some information here just on active versus passive management. So most of your heavier fee loads are going to be related to active management rather than utilization of investment indexes. And we have a few asset classes here: U.S. equity, emerging market equity, and fixed income, where you can see that the system's active management actually had outperformed the passive managements in a number of asset classes and in various time periods. So we are getting additional benefit from that active management function that we incorporate into our investments. Moving on to page 11, absolute return fees. So these generally are one of the higher fee loads related to the system. Absolute return comprised 8.7% of system investments and represented about a quarter of all management fees. While this year's return did exceed the system's assumed rate of return. It has lagged in prior years and has performed below benchmarks for the 1, 3, 5, and 10-year periods. Our next comment request is that given the historic low rate of return and underperformance relative to benchmarks and the high management fee structures, we've asked the system to comment on returns for the absolute return asset class, including the market conditions leading to the low levels of returns and benchmark underperformance, and what conditions would result in markedly improved returns. I would note that the asset allocation has been revised to reduce the allocation to absolute return asset class going forward. The next category for fees would be the private equity fees. So similar to absolute return, this is a heavily actively managed asset class and has high fee structures. Similar to absolute return, private equity comprised about 23% of management fees, while comprising a little over 17% of system assets. However, the private equity return was 51.85%, which was slightly below the benchmark, but I would note that returns for the 1, 3, 5, and 10-year periods ending June 30, 2021 were 51.85%, 20.93%, 19.76%, and 15.97% respectively. And those 3, 5, and 10-year returns also provided excess over their benchmarks. Moving on to page 12, Chapter 2202 of 2019 required the system to provide some more detailed information on carried interest on investments. This is the typical fee structure is you have an underlying management fee, and then there's carried interest, which is fees that are a percentage of any gains that are had. And so in that reporting, the system notes that the system tracks this on a calendar year basis to coincide with the system's financial auditing schedule. And so for calendar 2020, the carried interest was 203.6 million. And I would note that this indicates an implied share of investment profit of over 1 billion for that time period. So this is an instance where high fees correlate to high returns coming into the system. We just asked the system to provide an update on the estimated carried interest for calendar 2021 at the bottom of page 12. The next item to cover is investment division staffing. You just heard a few legislative proposals related to this. In 2018, the board was granted authority to set the compensation and personnel in the investment division, including the ability to establish positions within the division subject to certain limitations. The idea was one, to both shore up the staffing for the current functions, as well as to be able to bring in additional staff as the plan moves into shifting some investments to be managed internally rather than externally. Moving on to page 13. The system has been able to hire additional staff since been given this authority. They've grown by 15 positions and undergo periodic review of the division's operations to evaluate the need for future positions. Regarding incentive compensation, based on fiscal 2020 investment performance, 19 staff were eligible for incentive compensation. And based on fiscal 2021 returns, 21 staff were eligible for compensation. As we discussed earlier, these incentive compensation payments are paid out over a 2-year period, and they're earned based on the performance of the assets under an employee's management. So there are multiple components to this. They're based on performance of the assets to the system's actuarial rate of return, system's policy benchmark, and then also asset class specific benchmarks. And I would note at the November 2021 investment committee meeting, the board did approve some changes to various asset class benchmarks. And so the reason I note this is that given that the incentive compensation is tied to, has components where the performance relative to the asset benchmarks make someone eligible to compensation, just ask the system to comment on whether there will be any review of those benchmark performance thresholds that must be met in order for an employee to be eligible for that incentive compensation. Moving on to page 14, the second purpose from the legislation in 2018 was to be able to build out the planned system staffing to move into externally managed assets. At its September 2021 board meeting, the system CIO noted that the implementation of the investment division staffing and internal management objectives over the next 4 years will cost about 9.4 million and result in an estimated 2025 budget of 24.6 million. While the division budget is expected to increase over the next several years, the system estimates that management fee savings from internal management will far exceed the additional costs to the division. By 2025, they're anticipating the total amount of public assets managed internally to be roughly 24.5 billion, with private market co-investments a little bit over 2 billion. The system estimates that the expansion of internal management to result in fee savings of roughly 86 million in 2025, exceeding the estimated additional cost by about 76 million. Moving on to page 15 on Exhibit 8, we have here information on how the system has been implementing the internal management program. We have a few asset classes that the system has been managing internally, starting with treasuries and then various bonds. I would note most of these, the bottom three, the inception dates are relatively new, with the most recent one just being this past July. So we've asked for the system to comment in more detail on how their internal management implementation is progressing, including a number of metrics about how they develop proficiency in managing those investments, and how they evaluate the performance compared to available external management services. Turning to page 16, Exhibit 9 shows the returns for the Terra Maria program. The Terra Maria program is the system's emerging manager program. Total assets devoted to the program increased to 2.7 billion in fiscal 2021, up from 2.5 billion in fiscal 2020. System returns were substantial, with an overall program return of 32.1%, which also outperformed the program benchmark. All 4 fund managers experienced significant returns, with 2 of the 4 returning above benchmark. And by asset class, 3 of the 4 asset classes had significant returns that were multiples of the 7.4% assumed rate of return. And the rate sensitive asset class failed to exceed that mark, though its return was also substantially above the benchmark. Since inception, all 4 program managers have had returns above the system's assumed rate of return, with 3 of the 4 outperforming the benchmark. I would also note that Terra Maria is an actively managed program, and a number of Terra Maria investments returned in excess of passively managed system assets, as well as actively managed non-Terra Maria managers in the system. The final item on page 17 is the system's currency program. Starting in fiscal 2009, this was a program designed to provide some protection against fluctuations in foreign currencies, since we invest on a global scale, but our retirees are US based when we bring money back and have to sell investments. This program provides a little protection against currency fluctuations that could devalue some of our investments. Since inception, the program has added almost 275 million in value to the system. And Madam Chair, with that, that concludes my presentation.
Thank you, Philip. A lot to digest, but I will say, Madam Treasurer, considering what you the portfolio you had and the performance you had when you first came into this role and how you were leaving it, I would very much give you credit for much of this growth. Or you should take credit more.
Thank you. I'm not at all sure it's deserved, but as a future beneficiary, I appreciate it very much.
Are there questions? Should we take questions now or after?
I am not seeing any hands.
Okay.
Madam Treasurer, would you like us to go to Andy? Okay.
Okay, my mic is on. I'm ready to go. Okay, good afternoon, and thank you for the opportunity to be with you this afternoon. It's great to see Treasurer Kopp again and do this one more time with her and get the opportunity to meet the new treasurer. Welcome. So I'm looking at my clock, 2:59, 15 minutes, straight up 3:14, we'll be done. So today, I wanted to do a few things. One is provide an update on where we are this fiscal year, just to keep you up to date on what's going on in the program in real time, and then update the investment program with reference to the excellent analysis that and questions that are provided by Philip. There are 6 of them. I don't think I can address each of them in turn in 15 minutes, so I'll talk generally and hopefully I'll capture most of them. I will apologize upfront as Mr. Anthony was speaking. I realized we answered the wrong question on carried interest in our written document, so we will revise that and provide you that we answered it for the fiscal year, and he asked the question for the calendar year, and we just missed that. And I realized it when he was speaking, so we'll fix that and send that along to you. And then finally, we can circle back on this topic of real estate oversight if there's time and interest at the end of this, or we can follow up with written communication later, however you want to proceed. So just if that is acceptable, I'll move on. Okay, so through November, the plan was up just a touch below 4%, net of all fees, about 3.9%, and we're tracking a bit ahead of the benchmark. Not as robust as last year, but still making good progress toward our now 6.8%. And this year, the private markets have been leading the way with high returns and beating their benchmarks, which is a flip from last year, where the public markets had such strong results and the private ones were strong, but they weren't adding very much on a relative basis. So as Philip mentioned, last year was a strong year. We had record returns, and those returns were enhanced meaningfully by the work of our staff and our managers, as also noted in the analysis. And as much as I'd like to keep talking about how well we did last year, I'll try to address some of the questions on the implementation. And Philip's write-up does a very nice job of describing the good things that happened last year. But if I may come back to them in future meetings, just to remind you of the good feeling we have today. So as Philip noted, markets were particularly volatile during 2021, which led to some big moves in relative weights in our asset allocation. The board sets an asset allocation target by different asset classes, and as part of my job and the staff's job is to manage through time to stay with those allocations. So as an example, stocks were up over 40% last year and bonds were down. And so that would have led to if we had done nothing, about a 5 percentage point move toward stocks from bonds into some other places in the portfolio if we had done nothing. And so we moved about $2.5 billion out of stock managers toward bonds and other asset classes during the year, and generally used those opportunities to take money from managers where we were concerned about their ability to perform. They hadn't been performing for us. And so we focused our money more with managers that we had more confidence in and used it to rebalance not only the asset allocation, but the mix of managers and the types of styles that we had more confidence in going forward. So that's on the public side. Had the similar impact on the private side. As Philip also mentioned, the private equity portfolio was up over 50%, which was twice as much as the overall plan, basically. So that grew from about 13% toward 18% of the plan. And we really don't have a mechanism to adjust that. From a structural perspective, the board looks at public equity and private equity together as a 50% target to what we call growth. And this is the part of the portfolio that we expect to provide the engine of higher returns over the rest to drive growth. And then I have other parts of the portfolio to drive income and to moderate the risk coming from stocks. So what happens is if private equity becomes larger, then we reduce our public equity portfolio to stay around that 50%. And so that's what we've been doing, is emphasizing a bit more the public market this past year. Over time, we will rebalance our private equity holdings through the amount we invest every year in new funds. And so we're kind of dialing back this year on how much we expect to put in private equity funds to sort of bring that back in line over time. Again, as Mr. Anthony noted, most of the asset classes performed well, and you can see that in the Tux rankings that he referenced. That is the result, many of those things are the result of programs that we've put into place over the last few years to specifically target the places where we were not performing and find solutions. So it's not just the managers we employ, but also the techniques we use to manage the portfolio were important in making that happen. So to address the ones that were lagging, the three asset classes that didn't keep up with their benchmarks last year were private equity, natural resources and infrastructure, and absolute return. Private equity, as Philip mentioned, we really don't have any concerns there. That was driven largely by 70 or 80% return for venture capital, which the system is building a portfolio, as we've talked about in the past. But we didn't have as much as the benchmark, and we didn't have a long enough history. Most of the really big returns were in funds that were originated before we started to ramp up our exposure. Our venture capital was up about 55%, but not 70 or 80. We don't think that continues, and we have confidence in that portfolio. So not doing much to change there. Well, hoping to keep on performing well. The absolute return portfolio, which we have two questions on, basically, it has been struggling longer term to meet our own return objectives. This past year actually helped it meet our longer term return objectives from a return and risk perspective because it was so strong, but still struggled against the benchmark. And it's always suspect when somebody comes in and complains about the benchmark. But in this case, we have been unhappy with the benchmark, and the board has actually made a change. The issue with the benchmark is that it is what's called a fund of funds benchmark. Fund of funds means it looks at the performance of managers who are doing what we're doing, which is going out and hiring a number of hedge funds and other strategies and putting it together in a portfolio and providing them to a client. And so we look at those because they generally are trying to do what we're doing. It's been hard for the system to do this, and it's been hard for the managers, so hard that the people in the index, the number of firms in the index used to be over 100, and it's fallen down to about 20. So, and this the concept in investment called survivor bias. So the 20 who are left are really good at it. So it's not a really strong representation of what the market is providing. It's showing us what really good managers are doing. And it's pretty volatile, and actually the sponsor is thinking about eliminating it because it's not a big enough sample of managers. So we moved to a new benchmark, which does not change really the longer term return targets, but we think it's going to be better at capturing relatively short periods of time, like a year or 6 months, where this benchmark has been bouncing around and making it difficult to interpret what we're doing. So that's the benchmark issue. But we also, as Philip mentioned, we recognize that this is a difficult asset class to generate returns in, and generally size is a problem. If you get the bigger you are, the harder it is to make money here because you wind up competing against yourself. And so the board reduced the allocation. Effectively, what that does is hold this portfolio the same size. We used to be 8% of a $55 billion portfolio, which is about 4.4 billion, and we've moved it to 6% of a $70 billion portfolio, which is 4.2 billion. So it's about the same size as we've been trying to implement, but we think that'll help us maintain our ability to access the right amount of managers. And broadly, what we have found, and the reason we think the performance is improving, is that historically we had a very narrow view of what we were trying to do, and in that portfolio, and over concentrated in a very few strategies that didn't provide enough return. And so now we've broadened out the types of things we're doing. We've added a little bit of risk to the portfolio, and we think it's going to continue to improve relative to that benchmark. And finally, natural resources and infrastructure is another place where we have benchmarking challenges. We have a mix of private assets and public assets. And we have a public market benchmark, which moves around a lot, it can be very volatile. But even accepting the benchmark challenges, we haven't done a particularly good job of investing in this portfolio, mainly not so much from the managers we've hired. We have a history and a demonstrated ability across asset classes of identifying good managers. But we focused too much in mostly energy funds in this area. And just that much focus in energy has been a problem related to a previous topic you were discussing on climate change. That's been a challenge for them. So it wasn't a lot at the portfolio level of energy exposure, but in this portfolio, it's been a challenge. So two things we've done. First, we hired a new managing director for the asset class, and she's had a successful record of building these portfolios. And so we're looking forward to her insight here. And then secondly, the board changed the asset allocation to focus more on infrastructure than natural resources. And that came largely from our work of including climate change and climate change risk into the asset allocation process. Without that work, we would have kept the allocation more toward natural resources and infrastructure. So it kind of blends again back to the conversation we just had you just had a second ago on how we're handling climate change. So this will take some time to build out as she's identifying private funds, but we have confidence that one, moving more toward infrastructure, and that the absolute returns of this portfolio will improve and meet our longer term objectives, and that the benchmark, as we move more to private assets, we can consider a private market benchmark, which will be a better fit. 4 minutes, let's see. Okay, as Philip referenced in the report, another measure of performance is our peer ranking. The peer ranking ranks us versus other large plans. And the 3-year record shows that we've been basically in the upper half of the 3rd quartile, which is not like anybody's dream. We want to always be in the 1st quartile, but adjusting for our asset allocation, that is that's pretty good performance. And if you stay there over time, you wind up moving closer to median, which is what you see with the longer term numbers. We're better than the average of the 3-year numbers because we're being more consistent. And this improvement in performance has not come because the board has adopted a more risky asset allocation to be more in line with peers. It's come from better implementation of each of the asset classes. Again, looking at the TUX ranking by asset classes. And again, that has come from a deliberate analysis of why we were not meeting our objectives, developing a plan, putting the plan in place, and having that bear fruit. So that's good news for us on from the TUX survey. And in our report, we note that the TUX survey is kind of narrow, and it looks at returns on a gross of fee basis. If you look at net of fees, which is what we actually have to pay benefits, and have a broader analysis of more plans, we look even better relative to those. And most importantly, we've improved the returns without adding risk. So we've moved to the top decile of funds, or near the top decile for risk-adjusted returns. So we're being really effective at what we're doing. As Philip mentioned, we're building out the internal management capability. And this has happened. We now have about $9.5 billion of assets. We do have a robust process to make sure that we are not just creating products where we don't have skill. All of these are go through a development phase where they prove the concept. They go through a paper portfolio where they run it to demonstrate effectiveness. And then we put them through the same underwriting process as our external managers, which means they're reviewed by our whole team. After they're funded, we have an independent oversight committee of people who are not involved in the public market assets. And then the whole team reviews them once a quarter. So we have lots of eyes on it. We also have our general consultant provide some analysis before we start it, and then they include them in their evaluation of all our asset managers after implementation. So lots of oversight and structure around making sure that we are only managing money that we should be managing. So in the last thing I'll mention is We also, as Philip mentioned, working on these co-investment transactions. These are private investments that managers are making for us within their private equity funds generally. But they invest in, the size of the investment is too big for their funds sometimes. So it gives us the ability to scale up our investments in something we're already invested in through the fund. And we can do it at 0 or low fees relative to the 2 and 20 basically of a private equity fund. We can do it for 0 and 0, which is impactful for fees. So far this year, we've committed to 9 private equity co-investment companies or vehicles, and that's about $200 million. And that'll save us $3 to $4 million a year in fees, and then eventually in terms of carry, it'll be very impactful. We've also made some of these investments in other asset classes. So with that, I refer you to our memo, largely prepared by our Deputy CIO, Bob Bird, and ask if there are any questions or if you'd like me to follow up on the real estate topic.
Any questions from any members? Delegate Krim.
Yes, Madam Chair. Yes, I would like you to follow up on the real estate question. What concerns me the most is what we are doing in the pension fund about racial equity, one thing, but also how is our real estate investments done? Are they done through like a real estate investment trust, through a REIT? I mean, as I stated previously, I've read some things where they're not very good landlords. You know, they don't do repairs on buildings, they evict people, you know, so how much input do we have on things like that? Or do we just, you know, take the money as a good investment? That's my question.
Okay, I'll work to try to address the question. So the program itself, at the moment, we invest through private funds. We have the opportunity, we can use real estate investment trusts if they make sense for us. They tend to be more volatile, they act like stocks, so we tend to try to invest through private funds. There are different kinds of private funds. There are what we call core open-end funds, where they buy properties that are fully leased up, they don't have very much debt on them, and we just try to get the income from them over time. Other strategies, they'll buy properties that maybe they're not fully leased, or they have some kind of challenge that they think that they can manage and improve and get it fully leased, and that'll increase the value. So they're trying to increase the value of the property, less focus on the income. And then there are more opportunistic ones where maybe they're building an apartment building or a warehouse or something like that from the ground up, and then they're going to lease it up and they'll get paid for taking that risk of doing all that. So there's different types of things, and we do it, as I mentioned earlier, we do it for office buildings, apartment buildings, retail centers, warehouses, lots of, now we're moving into more digital buildings, some healthcare buildings. So lots of different strategies. And for the process we use is that we hire these managers who, and we talked about responsible contracting. Our whole diligence process is trying to find managers who have a strong reputation of acting appropriately and doing the things that they're doing. So they would be buying the building from the person who's not maintaining it because they think that's an opportunity to improve the performance. And sometimes it does come with higher rents, which is a problem for some of the tenants, but they follow industry best practices on how to deal with that situation. They don't just come, and push people out onto the streets and stuff like that. And so we get reporting. We do a diligence process that includes a background check on the firm and its operations. So we'll identify any lawsuits and those types of things where you might have seen bad practices in the past. We provide them with our responsible contracting policy. We hope that they have their own. If they don't have their own, we offer them ours. And if they don't have a responsible contracting policy, which generally focuses on how they contract with people to do work at the facility, how they treat their employees, those types of things, and following the rule of law, those types of things. We will evaluate what they actually do to understand if they implement a responsible contracting policy, even if they don't have one. So we really try to understand all that. And then our team gets reporting back from the managers, and in our side letters and our documents, they need to report to us if they have any meaningful litigation against them, so we can know. To your last question, we don't have control over these assets because we're a partner in a fund. So our biggest control is, before we go in, making sure it's a partner we have confidence will be acting responsibly. And then if they don't, we can just not do the next fund and try to get our money back and move on to the next one. So I hopefully that answers your question.
No, do you get a list of complaints? I mean, do you ever see like a list from the manager?
We as I said, if we don't necessarily get tenant complaints, but if it winds up to be a legal complaint, we would find out about that. There's lots of friction between tenants and landlords. We're not going to get every one of the frictional points that people have, but we do. If it comes to a legal point, then we will definitely get notification.
So somebody that may have a leak in their house, or have paint falling down, or have lead paint in their house, we wouldn't hear about it, but we'd be part of the ownership of that building. Is that what you're saying?
I'm saying that if that was the situation, that the building would have a hard time replacing tenants, and the value of the property would go down. So it would not be. There's no incentive for our managers to act in that fashion. Their incentive to make sure the property is fully leased, in great shape, because they want to sell it to the next investor that is going to own it. So we don't see that. Occasionally it might happen in a particular property, and then we work with the manager, make sure that they are dealing with it appropriately. If it's a health violation and they get cited for having a building where people are put at risk, we will get notified of that. So I don't think we're in the types of investors that you're reading about, but to the extent we've had people come to the board in the past and say we think this is a bad situation that this owner of this building is involved in, and the treasurer has helped us in our response to those. And the responsible contracting policy is in effect a response to those inquiries, and the board makes it known to the investor that we expect them to be appropriately deal with any of these issues. And if they don't, then our major recourse is to not invest with them again. And we're a significant investor that, and there's lots of us that have the same types of policies.
Still a little uncomfortable with this, Madam Chair. So, but I know you have to move on.
Nope, no, I appreciate it. And we can have further conversations on this. Thank you. Delegate Proctor.
Thank you, Madam Chair. My concern is very much like Delegate Krim's. Seeming to me, investments in things like like a REIT would be fairly simple and direct, but to be invested in real estate directly could become very complex and complicated. So I guess my question is, what do we anticipate gaining or improving as a result of this change?
Well, thank you for the question, Delegate Proctor. So the question is basically, why would we want to do any own properties directly relative to through a fund or a REIT? And the answer is largely control and cost. As we've talked about in the past, one of the things that I think we need to do as a system is take advantage of our size and reduce the what I call leakage between what the assets return and what gets available for beneficiaries. And part of that leakage is the fees. And so the more we can get close to the assets, the more of the return we can retain. So that's the big driver of thinking about these things, is that it becomes overly expensive to continue to invest through funds, even through REITs, because they have management fees inside them. And we believe we can potentially build a portfolio of assets that have the same risk characteristics of things we're paying managers for and do it with lower cost. So that's the bottom line reason to do it. I've worked in firms that have invested directly in real estate my whole career until this one, and I'm confident that it's a exercise that the system could do. We used to do it back in the 2000s, early 2000s. We had direct properties, but we didn't have the staffing to support that, so we moved away from that toward working through funds.
Thank you.
Any other questions from delegates or senators? Great. I don't have any questions. Chair Elfreth?
No, I just want to thank Andy for that very thorough review.
Yep. Any final comments from any members on anything that we've heard today? Any questions, thoughts, ideas? Delegate Krim.
I just want to say goodbye to Treasurer Kopp.
Yeah.
She's been with me since I've been in the legislature at many things, and her work on the Board of Public Works, obviously. So
Yeah.
Good luck to you. Enjoy your restful retirement. I hope that's what it is, and good health to you.
Let me just, because someone just asked me a question here, make it perfectly clear. It's been an honor to serve. It's not only been an honor and a privilege, it's been a great pleasure to serve, and I appreciate your support and friendship very much. It was not an easy decision, but I want you to know that someone asked whether the Speaker of the House had urged me to retire. I just want to make it clear to you, my friends, that I had to convince the Speaker of the House that the timing was correct and that we had a very good successor. And many of you know me, there are other parts of my life that it's time to pay a little more attention to, and I'm looking forward to it, but I'm looking forward also to maintaining the friendship, and I will be cheering you on from the sidelines with great appreciation and affection, and I thank you.
Thank you. Well-earned retirement.
Yeah, and make sure you leave your email address behind, Treasurer.
I will be sending out a message.
Senator Eckert, did you, or Sarah?
I just wanted to say, well, Treasurer Kopp and I go back. Wait a minute, let me get the other meeting muffled. I'm sorry, I'm doing two at the same time. But as Treasurer Kopp knows, we go back way before I even came to the legislature. And I alluded to that in the chat because we used to have our women legislators meeting over at Manresa. And that takes us way back, right, Treasurer?
It certainly does. And they were great meetings. Too.
They were great meetings. And, so we've had a great relationship through the years. And I've enjoyed, as I've said to her leadership, she's been an inspiration and just a solid, consistent, dependable, served us all well. Thank you so much, and blessings in your next adventure.
Thank you. Thank you very much.
Senator Elfreth, you want to take us out?
Sure, unless Treasurer-elect Davis would like to.
Madam Chair.
Oh, Senator, yeah.
Might I say a few words?
Of course, Senator Griffith, always.
Thank you. I had the extreme pleasure of serving, as did Senator Eckert, with the treasurer on the House Appropriations Committee before she ascended to the office of treasurer. And just so much admiration for her work with the subcommittee there, and ultimately her leadership in the office of treasurer. What a skilled communicator she's proven to be. Took the information that our office receives from the office of the treasurer to a next level place where we actually had real-time information about what was happening in our district, something I hadn't seen in my years in the General Assembly. And working with one of my favorite people, Ann Gothrop, just continuing to bring the information to us in language that we could understand. And You know, ultimately getting over to the Senate, working with Philip and the committee over here. Madam Treasurer, you have been consistent no matter what room I'm in. You have been just a joy to work with. And then to pass the gavel or pass the torch to my friend and colleague who I was sworn in 4 years after him, even though I ran against him in 1994, to see the gavel handed over to this barely younger than me young man. And it's just a wonderful day. And I know that he has big shoes to fill. So I just wanted to thank you so much for your friendship and your service, and join with others who've just their appreciation for your wonderful public service. Thank you, Madam Chairs, for allowing me those words.
Once a chair of pensions, always a chair of pensions, Senator Griffith. But I would just like to add on, I heard the theme throughout, which is partner. And Treasurer Kopp, you have been a true partner to this General Assembly and certainly to this joint committee. And I just want to thank you. And I know we have someone who will follow that partnership very, very well, Treasurer-elect Davis.
Thank you. I look forward to great things from the General Assembly and from the pension system, and we'll be depending on both. Thank you.
Hi.
Please.
Thank you. First of all, I too want to extend my heartfelt congratulations on a well-deserved retirement to Treasurer Kopp. I was with her yesterday at the Board of Public Works. As far as her having big shoes to fill, I think someone should talk to the Lieutenant Governor. Treasurer Kopp and I and the room had a big laugh. The Lieutenant Governor looked at her feet and said, "Those shoes really aren't that big." And we went from there. You had to be there to hear it, but it was hilarious. I want to thank Treasurer Kopp. I had the privilege of serving with her my first 8 years. And she's been everything that everybody has said about her. And over the past few months, but in particular the last week, she and her staff have been tremendous to me in terms of helping with the transitioning, inviting me to every place I needed to be. I have more homework and documents to read than I read in, I think, 7 years of college. But it's all useful information, whether it's the 529 and all those different things that are going on. I'm excited about the opportunity, and I'll close. I don't want to get started again. I'm excited about the opportunity, but it is daunting when you follow Treasurer Kopp. I told someone today when they said you had big shoes to fill, I said, I'm not going to even try. I'm just going to do the best that I can do to make her proud, to make those of you who made this happen for me proud. But I can't fill Treasurer Kopp's shoes, so I'm not going to embarrass myself trying. But thank you all for allowing me to participate. I enjoy, getting as much information and education on this as I possibly can. And please feel free to call on me at any time if I need to know something or you need to know something. I'm looking forward to having that same partnership. Thank you all.
Thank you. We're excited to have you. Thank you, Treasurer Kopp. Thank you, Treasurer-elect Davis, for joining today. This was fantastic. I'm going to let my co-chair, Senator Elfreth, take us out.
Sure. Well, this is the last joint committee meeting of 2021. We will see everybody back at the State House on January 12th. With that, I'll entertain a motion to adjourn.
So moved.
Second.
All those in favor of adjourning?
Aye.
Aye.
All right.
Aye.
Everybody have a lovely holiday season. We'll see you
Yep.
in 2022.
Happy holidays, everyone.
Holidays, everybody.
Thank you for your work.
Bye.
Thanks.